So now that we've completed the theoretical part of investment appraiser for AFM, I'm going to start a series of questions which I will be solving starting from now, RIDAG. And the way I'm going to do it is such that we'll increase the level of difficulty as we move on question by question. So if you look at this question quickly, you will realize that this is just a typical FM question, which you have done before in previous paper. So this will serve as a refresher for you before I build in some difficult concept from AFM into subsequent questions. And the last question I'll be doing in this series will be a question that will serve as a typical 50-mark question that you can find in section A of AFM paper. Yeah, so please stay tuned, put your notifications on, and please practice all these questions and even more as we go along. Right, so I'm going to start with this one. The major thing I want you to pay attention to for this particular question is the way I'm going to be treating taxation. I'm going to be treating taxation in a different way from the way you knew it in FM paper because it is totally different from the way you were taught. So for AFM, we are closer to reality. FM is not as closer to reality, but AFM wants you to treat cash flows as the way they are actually being treated in reality sense, because you will see it as we move on. Like I said, pay attention. Taxation is the main reason why this question will look different from what you probably knew when you did FM. But the same answer we're going to arrive at, but I'm going to deal with taxation in the way you should deal with it in all AFM questions. So I'm starting from what you know already and we'll build into the unknown territory. So let's look at this question. Like I said, take a moment, read through it. The requirement just want us to calculate the net present value and comment whether the project is financially acceptable. You know definitely how we will tell is whether the NPV is positive or negative. If it is positive, we're going to do it. And if it is negative, we will not do it. So let's build our cash flows from revenue. We have variable cost. We have fixed cost. Then this is also something important for you to note. And that is talking about, because there will be a disposal, because there's a scrap value of 100,000 at the end of the year of the asset. So, which means there will be loss on disposal because there will be net book value at the end of the asset. So we'll put that as well, loss on disposal of asset. That has to come in before we can arrive at our taxable profit. Remember what I told you, that is the difference between the way you knew it in FM and the way I am going to be doing it and the way you should actually be doing it under AFM. So loss on disposal, then you're going to deduct tax depreciation. You remember when you were doing FM, we're not doing tax depreciation. All we're just doing is to add back tax benefit. So that is not reality, because when you have a year of a loss, you don't have to pay tax. So you need to know whether you're truly making a loss in a year or not, for you to know whether you have a tax benefit or not, or whether you should be charging taxes or not. Right. So follow this format. So when we deduct all of this, then we can have a taxable income, which is like your profit before tax. And if you look at the questions, revenue has inflation of the totals is going to be at 4%, right? So which means volume times quantity, volume times price, then we need to put inflation. So for year one, that will be equals to 50 by 25, then inflation of 1 year. So multiply by 1 plus inflation is 4% for revenue, then raised to power 1, because this is just 1 year. Yeah, so I put that for year one. Then we need to do for year 2 to year 4. So for year 2, the volume is 95. The price is 24. And inflation for 2 years, that's raised to power 2. We have that for year 2. And for year 3, the quantity is 140 and the price is 23. And inflation for 3 years. And we have revenue for year 3. And for year 4, volume 75, price 23 as well. Inflation for 4 years. And that is revenue for year 4. So we have our revenue projected. We need to do the same thing for variable cost, volume times variable cost per unit. So for year 1, it's going to be volume of 50 by variable cost per unit of 10 multiplied by inflation at 1 plus 2.5%. Then raised to power 1 for year 1. Then we need to do similar, but because it's cost, remember, it's outflow, so negative, remember, don't forget. Yeah, for year 2, volume is 95, cost is per unit is 11, and inflation for 2 solid years. We have that, it's outflow as well, so it needs to be negative. Then we'll move on to year 3. For year 3, we have volume of 140. We have unit cost of 12 and inflation for 3 years. Likewise, it's outflow, so negative. For year 4, yes, negative 75 units, 12.5 costs per unit. Then raised to power 4 because it's 4 years of inflation. Yeah, and that is it for variable cost. For fixed cost, they already told us inflation has been considered, so it's just for us to plug that in. 105, 115, 125, and 125 as well. Remember, I'm working in thousands. Yeah. For loss on disposal, that is when this is being disposed, and that will be happening in year 4. So which means we need to calculate that. So I'm going to put that in working 1. So in working 1, let's do working 1 somewhere here. Let's calculate our tax depreciation so we'll see what's happening to our asset. The asset is bought at 1,500. So let's say this is year 1 up to year 4. They already told us it's on a reducing balance at 25%. You can see this. Right. So we're gonna have working 1. Let's say this is working 1. This is cost or opening. I can call this opening balance. This is depreciation, and this is net book value. Depreciation is at 25% of the opening, and net book value is the cost, which is opening minus depreciation. The net book value at the end of year 1 becomes the opening for year 2, and likewise it goes down like that. We have depreciation for each year, and what we'll see here is that at the end of year 4, we still have a value of 474.61 as value of the asset. So if the scrap value, which means the asset will be sold at 100,000 and net book value is 474, then we know that there is a loss on that asset of 100 minus this. So that's a loss of that figure. So that figure needs to come up when we're computing our taxable income. So which means at this point in time, we're going to have that loss being recorded. So we need to put it in. That's there. And we have tax depreciation, which we already calculated. Yeah. So let's put it here for year 1. Tax depreciation needs to be deducted. This for year 1. This for year 2. It has to be negative because we are deducting it. And this is for year 3. And this is for year 4. Yeah. It's important we do it like that for us to know what our taxable income is. Don't worry. You might be thinking loss on disposal, tax version, they are not cash flow items. Yeah. Before we calculate our present value, we will adjust for non-cash flow items. And that is the difference between the way you used to do it under FM and the way you have to be doing your investment appraisal in AFM. Right. So taxable income now, pretty easy to get because all we have to do is to add all of this together. There's nothing in year 0, so we're not going to touch that. Yeah. So taxable income. So from year 0 to year 5. Yeah, I put year 5 there, yeah, for a reason, which you will realize later, because there is something that's said in the question that taxes are actually paid in arrears. Please pay attention. It said RIDAG pays profit tax of 30% per year, 1 year in arrears. So that means when we start dealing with cash flow, these taxes that are due, that are incurred in each of these years, will not be paid in each of these years. They will be paid 1 year in arrears. However, we need to compute them in the year they are incurred for us to get the taxable income. So we have taxable income. Now, this is a big deal. Taxation cannot be calculated. If you don't calculate your taxable income properly, your taxation figure will be wrong and you will lose mark. So now we need to get taxation at 30%. So, and that will be equals to 0.3 times taxable income. And it's outflow, so it's going to be negative. So we have that. These are taxation for each year. So now we know the taxation for each year. This is taxation that is incurred each year, but we know it will not be paid in that year. Not a problem. Just keep following. So profit after tax will be equals to taxable income minus taxation. And we have that as well. Please stay close with me and follow through. Yeah, very important that you get this section correctly, because when we start building difficult concept in AFM, this should not be a big problem for you. You have more things to learn. Yeah. So now that we have profit after tax, we know for sure that this profit after tax has a lot of non-cash flow items and we need to adjust for them. So now we can do adjustment for non-cash flow items. And the first thing is to add back depreciation, because we deducted it, but it's not a cash flow item. So we're going to add back depreciation, which is tax depreciation here. You can see that's talking about this line. I've adjusted for that. Likewise, this loss, we need to add it back because it's not a cash flow item. So add back loss that was deducted. So that loss amount was in year 4. So I'm going to add it back instead of, because we have deducted it before. So I've added back loss, I've added back depreciation. Now I can now bring in the cash that we received when we sold the assets. So proceeds, that's the cash that we need instead of the loss. It's proceeds on sale that we need. And that is 100. We know that. The question told us here, 100,000. So now there is more adjustment that needs to be done. And that's talking about the way the taxes will be paid. This taxation that we incurred in each of these years will not be paid in each of these years. They will be paid in arrears. So to adjust for it, we need to add back the tax in those years and now deduct it in the year they will be paid. So add tax back, then deduct tax payment. So I will call add tax accrual back, because this taxation is accrued one, because it's not going to be paid in those years, but to be accrued. Yeah, but they will be paid later. So I'm going to do that quickly. So I've added it back, but now we can now deduct it year 1 year for arrears payment, which means it's going to be delayed, just like that. And I hope it's making sense. With this, we can now get our total trading cash flows after tax. So pretty easy. All we have to do now is to sum our profit after tax that we are trying to adjust, and with all those adjustments, and we have the total cash flows coming from the trading activity. Now, all we need to add to this now is the statement of financial position items, talking about the initial outlay. So I'm going to add initial outlay. Remember, this is a simple question from FM. The only thing I need you to pay attention to is the way I've done this adjustment, especially as relates to the taxation. Yeah. So initial outlay is 1,500. I'm going to put it there. And that's the only thing coming from the statement of financial position. Yeah. So with this, we can finish it quickly. Yeah. So total cash flows, which are final cash flows. We can have a final cash flow now. Just this. Up to that. So we have our total cash flows. To get your net present value, there are two ways to do it. You can get your discount factor, or you can use Excel formula. Yeah, and I'm going to show you how to use Excel formula because it's going to be allowed in your AFM exams. You can use your Excel formula to do it. Remember that your initial outlay is already discounted, so you don't need to discount that again. This is what you need to discount, year 1 to year 5. So which means what I'm going to do is to add this one, is already discounted, plus present value of all these future cash flows. And the rate we're going to be using will be 7%, because I know the question tried to confuse us by bringing 12%, yeah, which is before tax, and giving you after tax. Remember, our cash flow is after tax. Therefore, we need to use the cost of capital that is after tax. So 7% is the rate that we're going to be using, comma, then you just drag all those cash flows, close the bracket, and you have your NPV, 1615. If you want to use the manual method, remember, you have to get your discount factor. Discount factor. For year 0 is 1. For year 1, that is, I have to check that quickly. That will be, I need to bring in the discounting table. Yeah. So let's check out, or I might want you to even try and do it on your own to see whether you're going to get the same thing, which I believe you should. That's talking about the discount factor at 7%. Let's bring it out. 1 second. Let me look for. So at 7%, we'll be using. You can just quickly calculate it instead of even picking it from the table. You know, what you can do is use your normal equals to 1 plus 7% raised to power minus 1. This is 1, yeah. Let's see, this is 1. Yes, for 5 years. 2, 3, 4, 5. Yeah, so I have that. raised to power minus this. Yeah, so we have a discount factor. Yeah, that should be a discount factor. And you can get your PV by multiplying the discount factor by the cash flow. This is the cash flow. So all of that all the way down, and you get NPV, which is the addition of all of them. Because the sum of all of the cash flows in PV together, you can see you get the same answer. Yeah, the same thing. So whether you use your discount factor manually in a long way or just use your Excel formula, you get the same answer. But please practice using the Excel formula so that you can get used to it as you're going to have it in exam. So next question will be a bit harder now because I'm going to go into foreign operation investment. So stay tuned and remember, put your questions, comments. Let's keep going.